improve the availability and the cost of mortgages and prop up housing demand in the US. He also believes that markets have perhaps turned the corner as the transfer of risk from the private to the public sector is reviving appetite for investment. Dariusz Kowalczyk is Chief Investment Strategist at CFC Seymour, joining us now from Hong Kong. Dariusz, I mean, there are obviously pros and cons of this move. Talk to us first about the cons.
The cons would include increasing spending by the U.S. government as they need to purchase mortgage-backed securities issued by the two GSEs, as well as assume potential risk of both of them going into negative equity. So fiscal position of the US government is deteriorating, and this sooner or later has to push treasury yields higher, which will partly reverse the positive impact of narrowing spreads of debt issued by Fannie and Freddie over treasuries.
And
so
what exactly
would fiscal deterioration would be the main problem.
And what would be the implications for the US dollar, which of course has been enjoying a bit of a time in the limelight, but could that be soon to fade?
Here there are two factors. The first is that deterioration of the fiscal position is definitely dollar negative, and I was quite surprised that following initial decline yesterday morning, the dollar rebounded in European and US trading yesterday. On the other hand, maybe this was caused by hopes that US growth will be propped up by the move. If this is the case, then improved growth differentials would be favorable. Whichever is the case, I think that the recent recovery of the greenback has gone too far and that it should correct pretty soon.
Talking of correction, that's certainly the picture that we've got in the Asian markets today after their initial euphoria yesterday in reaction, of course, to Washington's bailout of Fannie and Freddie. What does that tell you, Dariusz, that essentially, you know, this might be a step in the right direction in terms of stabilizing the housing market, might, of course, help systemic risk in the financial market, but at the end of the day, the global economy is still slowing down?
It definitely is. The moves in the U.S. will possibly help the U.S. consumer if asset prices in the U.S. stabilize, but it will not avert the slowdown in growth elsewhere. And today's declines in equity prices in Asia suggest uncertainty among investors over what will actually happen. But I am still optimistic that we have turned a corner in financial markets, that risk appetite is going to continue to rebound. And remember, just after Bear Stearns' rescue, there was also a lot of volatility. The initial rally was partly reversed the following day. The same thing is happening today. It takes the markets a few days to digest the new situation, but I think we will see an upward trend in equities and other risky assets through the end of the year.
I mean, certainly we're hoping that the markets are starting to turn the corner or starting to show signs of bottoming, and hopefully risk appetite will return to the market, Dariusz. But still, don't you feel that earnings around the equity markets, let's just take Asia for an example, still might need to come down? They still haven't fully accounted for the slowdowns that are going to occur in the economies, and that is going to keep on pressuring share prices?
Valuations in Asia have come down quite sharply, especially in China. I think that rather than focusing on price-earnings ratios, the market will be driven by sentiment swings in the near term. Fundamentally, I think longer-term strong growth potential in Asia should justify current valuations. They have been depressed because of risk aversion globally, which now I hope will be reversed to a stronger risk appetite. In particular, when you look at valuations in China at around 15.5 forward-looking price-earning ratios for a country with very strong long-term growth potential, they are to me quite attractive. But again, of course, there it's sentiment that is driving the stocks lower. But for longer-term value investors, valuations, I think, in Asia are fairly attractive.
Dariusz, good to talk to you. Thanks for your time. Dariusz Kowalczyk, Chief Investment Strategist at CFC Seymour. Just ahead, the Shanghai market will be closing out